Hey, this is Matt from InvestiQuant. Today is Tuesday, January 5th, 2021. And today the market has been consolidating following yesterday's sell-off. So we've got lots of balance-like activity taking place between the different instruments. You can see S&P here just popped off the open, retested the open, and popping again back towards the highs, and hasn't really gone very far. So we've got about 29 points of range, which isn't bad, but is pretty light considering the prior day had over 100 points of range in the session. But we haven't done much damage in either direction. We have traded mostly higher, but what we've got happening here are inside days on all four of the instruments, meaning the lows today are above yesterday's lows. The highs of today are below yesterday's high. That's fairly normal when you open in the middle of a giant range, but what I figured we would do is take a look at what this type of activity has led to in a similar environment. So let me go ahead and set this up in Discover. We're going to be looking at all four instruments, and the setup's going to be based upon entering the market long at 3 p.m. Eastern Time. It'll exit at the close, which is 4:15 p.m. Eastern Time. Now for this pattern, we're going to be looking at an inside day, which I can create within the post-open filter section by saying the intraday high as of 3 p.m. Eastern Time is less than yesterday's high, and the intraday low as of 3 p.m. Eastern Time is not less than yesterday's low. So I put those two exclusions there, making those not statements. That creates an inside day pattern. Now I can put a little bit of context around yesterday's price action, and all I'm going to do is I'm going to grab this yesterday's direction for the last close was greater than 1% lower. So we had a sizable down day yesterday. So we've got an inside day on the heels of a 1% or greater move lower. And then lastly, I'm going to put it in a similar environment, which is below a 10-day simple moving average, but above a 200-day simple moving average, and click View Results. And here we go. So these are the results of going long at 3 p.m. Eastern Time when you have an inside day forming following a 1% lower move, which is above a 200-day simple moving average, but below a 10-day simple moving average. Historically, the S&P has had this pattern take place 61 times dating back to 2003. The NASDAQ has 80 samples dating back to 2003, the Dow 61, and the Russell 83 samples. So it's a fairly common occurrence to get that large move lower followed by inside activity, at least until the later portion of the day. And this does not mean that the day finishes as an inside day. It just means that at that point in time, which is 3 p.m., which is the entry time, it's an inside day at that time. So that's what that means. But we've got good sample sizes here. And if we look at the win rates on them, they are coming in a bit weak. We've got S&P, 39% of these closing above that 3 p.m. price. The NASDAQ's pretty neutral, so that one's 49%. The Dow, very similar to the S&P, 39%. And the Russell, 52%. So two of the four are pretty weak, under 40%. The other two are pretty neutral at about 50-50. If we take a look at average moves as far as an average win, average loss, looks like the average loss just a little bit bigger than the average win in the S&P. The average win is larger in the NASDAQ. The average win is larger in the Dow, and the average loss is larger in the Russell. So those are kind of mixed on which side has had bigger moves up or down. Across the four different instruments, it's 2 and 2 there. But if we look at the win rates, two of those, the S&P and the Dow, have been quite weak. The other two have been pretty neutral. So historically, some of these markets have not done well with this pattern in play as we approach the close. So hopefully you found that helpful. Good luck today, and we will see you next time.